Finally, we're joined tonight by Keith Watson and Robert Crayfourd, co-fund managers at CQS Natural Resources Growth and Income, ticker CYN. The CQS Investment Trust holds an active portfolio of global mining and energy equities in a closed-end trust. The fund is trading at a 52-week high of 194 pence per share, with apologies, that's yesterday's price, I haven't had a chance to check it today, and has returned more than 150% over 5 years and up almost 28% since the end of February, which is pretty scorching, so well done indeed to the team. Indeed, in 2022, CQS won the Investment Week Natural Resources and Commodities Trust of the Year. No mean feat. Welcome to Robert Crayfourd and Keith Watson.
Well, hi, thank you. Thank you for having us on today, and thank you for everyone that sort of stayed so late in the evening. I appreciate it. It's getting a bit late. We're into the graveyard slot, but hopefully we can tell you a very interesting story and keep everyone wide awake. But yeah, so we're here today to talk about CQS Natural Resources Growth and Income, and I'm under strict rules on time, so sorry if I fly through this a little bit too quickly for some. But yeah, so the fund, it's about 148 million sterling investment trust. So that means closed-ended. That gives a bit more flexibility around liquidity. It's on a discount currently of about 13%. It pays a dividend of 3.2%. And yeah, so who's behind it? So yeah, so CQS is a $16 billion asset manager, but just in the last few weeks, we've been taken over as our parent company. So the parent company is Manulife with about 1.5 trillion in assets. So you know, whilst the funds themselves aren't huge, just short of 150 million, we do have a lot of backing and big corporate backing behind that gives us all the infrastructure, IT, etc., etc. So a quick one on who we are. So clearly Keith and I are on this call today. We're the co-managers on this fund. I'm a geologist by education. I've been focused on mining and energy stocks since 2004. Keith, I don't know if you want to do a quick intro.
I can do. I've been working in the fund management industry and the resources sector since '92 when I started with Scottish Amicable. Rob and I worked very well together. Rob being the geologist, I did more engineering and tend to focus on the processing side. That is actually quite useful in terms of looking at some of these companies. Thanks, Rob.
Yeah, so a little bit more on where we're positioned. So yeah, you can see here we do a quick breakdown of our current sector exposures. I think one of the key things just to make clear on this is the mandate is relatively fluid, so that gives us quite a bit of flexibility, so we can allocate towards those commodities and areas that we see the best opportunity. So that is both in the underlying commodity price, but also valuation. So we're very value focused in our, and you know that's pretty key. And I think you'll see as we kind of break down through some of the sectors. We run 3 investment trusts, so this is one of them. We also run the Geiger Counter Fund, which is focused on uranium mining equities, and the Golden Prospect precious metal mining trust as well. So there's clear overlap here, and the best ideas from those are also reflected within this fund. So yeah, just talking on exposures. So you know, we currently see some very attractive opportunities in precious metals. That's because we see upside to the commodity price, but the main reason is the stocks themselves have really lagged this move, and we think are attractively valued. Energy, we think there's a really strong fundamental story to that, ultimately down to constrained supply. Uranium, you know, clearly one close to our hearts. We think that's got some fascinating or sort of fantastic fundamentals sort of driving that going forward. And then we'll touch on shipping. While we have a relatively low weight to base metals, we can have exposure to things like coal as well as energy transition commodities like lithium, and we'll kind of break that down in a bit more detail. Performance wise, so yeah, the fund's been a very strong performer. You can see here on an absolute basis and relative. Here we've got the performance or the fund itself, NAV in the dark line. Below that, we've got MSCI World Mining in blue and MSCI World Energy in the sort of slightly off green color as well. We put in just some details here on the top 10, just to kind of give a bit of a flavour. We do describe the fund as being kind of small mid-cap. One thing we just want to clarify on that to UK investors, that isn't like AIM small cap. This is more on a global scale. So just in the top 10 here, you can see, we haven't included the market caps, but they're all above $1 billion in value, with the exception of Karora, which is there at number 10 at sort of $0.95 billion. Within that, there's some larger names. EOG is at 75 billion market cap, and we've got the likes of Diamondback at around 45 billion as well. So so with top 10, fairly concentrated at around 40% of the portfolio. The top 20 constitutes 62% of the portfolio. So you can see a fairly high focus, concentrated portfolio in that. Below those names, we do have some smaller exposures as well. That's in some of the smaller market cap type names where you have more of a heightened kind of risk reward type profile. We think it's better to be a bit more diverse, and the positions aren't as concentrated below that. But within that, you can kind of see that focus I was talking to earlier. Heavy presence there from oil and gas, precious metals, and the largest position being NextGen, which is a uranium developer. Other than that, the rest of them are all producers, all free cash flowing. NextGen is just a truly well quality asset. Just on some key themes through the portfolio. So energy remains a real focus. We can see on this chart on the right. This is one of the key charts we think to kind of explaining. We hear about energy transition and renewables. I think it's important just to flag here that renewables still only constitute around 7% of global energy supply, and the requirement for fossil fuels is likely to remain. That big black slug in the middle is coal. Ultimately, that will be phased out, but probably to the benefit of gas and oil. Even with EVs, oil still going to have a very relevant presence going forward. We would the fund itself is about 51% exposed to energy, and that includes oil and gas at 25%. But we would also within that include uranium, which is the only source of zero carbon baseload power, ultimately essential to any emission targets set at COP meetings. But equally shipping, transporting, our exposure here is through crude shipping and LPG shipping primarily. And coal ultimately will retain a place, probably certainly more driven by emerging markets than in the West. But valuations are set by the West, and as a result, we think the perception of the valuation of those companies is overly bearish relative to the actual underlying fundamentals. Chart on the top right, I'll just reiterate here. This is EIA data, so US Energy Agency. They're just highlighting here how oil demand will continue to grow over the next few years, albeit at a slightly slower rate to what we saw in 22, as we're kind of coming out of COVID lockdowns. And as you can see through those red sections of the bar, that's primarily driven by China and India, and across non-OECD countries. So it just shows emerging markets remain a primary driver here. They can't afford EVs in the same way. Hybrids are going to remain a very important part of that segment. Yet at the same time, we're seeing supply being heavily constrained, given ESG requirements and focus on corporates who are now targeting dividends and buybacks rather than investing on new supply. So ultimately, that leads to a constrained market, and we believe positive risk rewards going forward because the equities are discounted and the underlying commodities should remain supported by constrained supply. Precious metals, conscious of time, it is a key theme in the portfolio. So we have gold just around all-time highs, but we still see reasons for that to potentially go higher. Primary reasons here being strong central bank demand, as highlighted by that bar chart on the right, which have been steady buyers for 10 years. So bipolarization of global geopolitics should continue to see central bank demand remaining very strong. And what we have seen more recently is demand in Asia has been the primary driver of this all-time highs that we're seeing. Yes, at the same time in the West, we've seen steady selling from ETFs and more broadly. So our view is if ETFs turn back to being buyers again, that could drive the gold price notably higher. But ultimately, our view here is even in a flat gold price, the stocks have really lagged this move. And we do anticipate a degree of re-rate as we move through the next couple of quarters. And that higher gold price starts to feed through into free cash flow, feeding through down to the bottom line. There have been some reasons that they've underperformed previously, and that had been cost inflation, which had ultimately squeezed margins. What we're now seeing from the corporates is that cost inflation headwind is now shifting to a tailwind as some of those cost pressures are starting to ease. But coming back to that main point, the stocks are at the lowest multiples that we've seen in history. And we believe that weak sentiment towards the sector or general lack of much interest is going to lead to a degree of covering, and people start to add back exposure. We still think gold adds an important defensive role to portfolios, particularly in an uncertain world that we see currently with geopolitics, whether it be ballooning government debt, US debt levels at 34.5 trillion, increasingly looking unsustainable in a higher rate environment, and add to that potential risk of stagflation as we're starting to see slowing GDP numbers and sticky inflation. I haven't got time to dwell on the names, so I'll move on and I'll pass that over to Keith.
Thanks very much, Rob. Yes, gold is a very cheap form of insurance in the portfolio. But moving on to uranium, this is something which we've been following for a considerable period of time. And I think the crucial point to note on this chart is that there has been, or there is now an outlook for a consistent and growing deficit in supply. The green line represents expected demand. The yellow line represents expected supply and includes, out to the end of this decade, production from both brownfield and some new greenfield projects. They're implicitly in there. More will be required. The key theme, though, is that following a decade of underinvestment and the recent energy crisis, that prompted a sea change in both government and public opinion towards the sector. It was a real reality check, and I think particularly with regards to the energy transition, which had to suffer a sort of pace change. It was no longer transition at any cost. It had to take place at a reasonably affordable cost. And the result of that is that there was a reassessment of the industry based on the reality of economics. Clearly, it's got the green credentials that Rob outlined as being the only zero carbon form of baseload. But as a result of all of that, we had very favourable policy and regulatory changes, which gave the utilities the ability and confidence to go out and recontract. Last year was the first in over a decade that they acquired as much material as they actually consume each year. And that is something in the context of the current geopolitical climate, which is arguably complicated by the US passing of its ban on importation of Russian material, only putting greater emphasis on the need to find new sources of pounds. And where are they coming from? That's the difficult bit. The market is very concentrated, and more diversification in order to secure supply is needed. We've outlined that NextGen is one of our key positions at $75 a pound. It's still trading at or about NAV, but this is a strategic asset with resource growth potential, scalable production, is allied to the West, and is very strategic either to others in the nuclear fuel cycle themselves, or maybe even to sovereign wealth funds outside of that. And for that reason, we still think, despite the rally in the prices, and particularly because uranium is a special case, and despite this rally, still only represents a very small proportion of the cost of producing electricity. At $100, it's maybe 8%, which is a huge contrast to, say, natural gas or oil or any other form of baseload production. You can still withstand higher prices. And I think that's probably something which we are going to see as the continued utility contracting cycle takes place. If you can move forward again, a slide there, please, Rob. The next one is the energy transition. I'd say this is very much a key theme, but there are times to emphasize this. And I'd say at the moment, we are seeing better relative value in the raw fossil fuel energy cycle, as Rob has already outlined. It is still, nevertheless, a theme that we have played. I would just talk to here, say, lithium, which typically garners most of the attention. You know, it has played into the talismanic EV market share growth that we've seen as governments have alighted on that as their sort of push to the public for transition. But what we've seen in the light blue line there is a very significant ramp up in lithium prices as that push took place. But then we had a bit of a crisis, spurred in some senses by demand being sated from the consumer, and a bit of a destocking cycle across the car manufacturing sector overall. That includes the internal combustion engine, but also EVs, at a time when some new project supply was coming on stream, as a result of which the price collapsed. I think, you know, our lithium exposure I wouldn't overplay at the moment, but to give you a flavour for our style of investment, I would note that, you know, we do look at these themes on a medium and longer term perspective. We take the commodity at the top down, and then we look at the value of projects from a bottom up perspective. And Rob, as the geologist, picked out an absolute winner in a company called Sigma Lithium, hard rock, one of the highest grades globally. And we started buying that in 2018. We actually largely had sold out of it at the peak of the chart there. But now that we've had the price collapse and the commodity appears to be forming a bit of a base as the Chinese lepidolite production starts to fall away, we're almost being tempted back in if we can see the valuations perhaps see a bit more of a correction. But, you know, we've just acquired a little bit more of the Sigma back. Copper I'll pick up on the next page. I wouldn't labour too much on this one, but we like copper as the base metal of choice because it's technology independent, unlike lithium, which feeds into batteries. I didn't listen to all of the Taseko conference, but you can see the bottom right chart there. It's often one that is rolled out for investors, but you know, we need more supply if we're going to deliver electrons from whatever form they come. And I think this is one of our preferred plays for energy transition from that's taking place. We've got some of our favoured plays mentioned at the top there, things like Foran Mining, Ero Copper, which is in Brazil. But right now, the valuations of these aren't necessarily as cheap as we would like them in the context of, as I said, the relative prospects and risk reward on offer in the energy space. I would say that in the short term, we're slightly cautious of the domestic Chinese copper demand, in that some of that, a large portion of it, goes into the property sector. And if we look at the bottom left chart there, I would just say that this is an attempt to show the outlook in trend of completions, which tend to absorb most of the copper, versus new property starts. The orange line is property starts, which fell off a cliff, but it is superposed forward 2 years just to show you the correlation of fit out that tends to follow it. That is the black line there. And copper will follow that fit out line, and we just feel that in the shorter term, perhaps the demand isn't going to be as strong as this consensus opinion seems to be forming, and or have formed in the context that the equities aren't necessarily at the valuation that we would prefer. But it is a classic sector which has suffered from underinvestment for the same reasons that we've seen across the commodities market. And there still has been far too little investment in it. And we'll look at it at some point in time. If you flip forward another page, this is shipping that Rob alluded to. Again, this is perhaps an even better illustration of the lack of investment that has taken place in vessels that transport energy around the world. And this shows the pipeline of new builds 4 vessels, and it is at an all-time low. And for that reason, with some uncertainty still on propulsion regulations, there is very little new investment going into this. And we've still got, for example, crude growth this year of 1 to 2 million barrels, maybe a touch more. We'll see. At the moment, growth projections are okay. But this is a sector which is benefiting hugely on the day rates and is one of the big dividend income streams that we're seeing in the fund. And for that reason, it represents a pretty healthy exposure. And we've held this for quite some time. The NAVs have benefited because they're now moving towards cash flow multiples, having been more based on NAV. And the NAVs of the ships have gone up because steel prices are still relatively high. And for that reason, I think I won't reiterate it anymore. Still a sector that we like. Pass over to Rob just to provide some conclusion, if that's all right.
Yeah. So a quick summary. So the fund itself, Keith and I are very value focused. We think one of the key things we offer here is what is a fairly fluid and difficult sector for new entrants or retail to invest in. We offer them that kind of expertise to allocate. We also, we know management teams, we know the assets. Many assets kind of get recycled, and we know many of the pitfalls to look for. So, we think that's one of the things that we offer is that kind of expertise in assessing how people should seek exposure. We think there's some great underlying themes, some strong fundamental drivers to those. Yes, performance has sort of plateaued over the last 12 months, having previously been very strong for 2 years. We think, that there's a good outlook going forward, given those underlying themes. Counterintuitively, it does play into a number of kind of ESG themes in that it's kind of constraining supply, and there's that energy transition. We do seek to gain exposure to that. And I just reiterate that, we don't own any iron ore, we don't own BHP, we don't own Rio. We think shareholders are able to do that themselves. We think, given disclosures, there's limited value add that we can kind of add to that beyond sort of broader macro. Look, we think it offers a good opportunity, and very happy to field some questions if there's any coming through.
Yeah, we prefer that. We like Q&A.
Thank you, Keith. Thank you, Rob. Who wants to take the first one? I'm going to ask you, the fund has been performing particularly well. I mean, 28% up. I mean, this is my sort of rough reckoning since the end of February. That's a pretty scorching performance. What's been driving that within the portfolio? Could you tell us what the star turns are?
Can I start there, Rob? I'd say that one of the contributors has been things like the uranium sector, which had seen the price move up to a 15-year high at 107. Yes, we've had a bit of a consolidation, but that is a position that has grown into that kind of scale, but is one that we're very happy to run as a strategic asset. Gold has been the other one, and I would say that there is a much greater focus now on the significant government spending that has been ploughed into economies, both in the West and in the East, and how that is going to be funded. And I think this has raised a real point of contention that the central bank certainly understands, sticky money that's been acquiring bullion and hoarding it, and I think is one that has started to gain traction in the public's eye. And if you've got 33.5 trillion of US government debt, continued debt ceiling negotiations to increase that, at the rates that we're looking at in the next 5 years, as bonds reset, they're going to be issuing over $1 trillion a year just to pay the interest. And I think that is something which is very easy to capture the imagination. And for that reason, we think the gold price is well set. But the key point is that the equities, despite the move that's contributed to this 28%, still have much further to run as a form of insurance in portfolios now. We think that is, it would be foolish not to have some of that in, and clearly we're quite large in that sector. I'll pass on to Rob to add any comments.
Look, I think it's been fairly broad brush across the underlying themes that we have. I think Keith touched it on there with Some of the macro drivers as well. I think the realization that inflation's a bit stickier does lead people kind of looking for some inflation protection. Commodities are obviously pretty empirically, historically have always shown relatively good inflation protection. So I think that's seen some flows into it. But there's also been some expectations just around China being weak that they'll be forced to kind of throw out big bazookas and look to stimulate. So that's also been offering some degrees of support.
Okay. Now we've had a question about BHP and Anglo. Can I ask you first of all, do you have money in either BHP or Anglo?
We don't, no. So as we sort of said earlier, we don't kind of focus on the mega caps because we don't feel we can add the same value. But we're very happy to comment on it.
Terrific. Okay, let me pull up the question. Peter Higgins. It's a takeover battle. Yes, one of the biggest ones in decades, he says, with BHP pursuing Anglo American with a rejected 43 billion takeover bid. Could this battle trigger more consolidation in the mining sector? Is there more to come?
I think what's firstly interesting there is we've seen very high levels of discipline among miners more broadly. So, similar to energy companies, are focused on dividends and buybacks. And have generally been cautious of M&A. So it's going to be interesting to see some M&A coming through. M&A is actually quite constructive because M&A, rather than new builds, doesn't add any new supply. So firstly, that's important in that it can kind of keep this theme running and keep supporting commodities. Now, M&A itself, yes, we do anticipate a pickup in M&A. We've seen an underinvestment in exploration and development of greenfield projects, especially by the majors. That's clearly what BHP's focus here is, to try and take Anglo's assets for the cheaper than it costs to build. So especially in the inflationary world we've had, it is often cheaper to buy than build. We've been focused on projects that kind of come a little bit earlier down the pipeline. So you look to the producers on the copper side, generally they're quite expensive. Taseko definitely, our prior presenter is certainly cheaper than many of its peers, but the larger peers are often trading on PEs of kind of 40 times. We can actually buy developers or late stage explorers with fairly tier one assets for less than the money that's gone into drilling them out in the first place. So it just shows that kind of valuation discrepancy. So we do anticipate M&A. We try and focus on it from that angle. Will BHP succeed with Anglo? I guess that's yet to be seen. I think there's some real risks around regulators potentially blocking that, particularly in South Africa, the South African regulator will clearly be quite cautious around allowing that to pass through.
You think it might fall at the regulatory hurdle?
Look, I don't claim to be any complete expert on it, but there are clearly risks to that and a protracted timeline. I think it's interesting that BHP are making this bid. I think the reality is that there's few quality copper assets out there. They're often in very difficult jurisdictions, difficult local issues sometimes, difficult geology. That's one of the reasons that does make it attractive longer term, even if we do see some risks in the near term. What
would your advice be if you were holding Anglo shares right at this moment? What would your advice be to a retail investor holding that in their portfolio?
Look, I mean, there's a whole load of uncertainties here, but BHP obviously upped their bid. And Anglo rejected it again. I think that's is quite a bold call. Firstly, BHP so far have only been bidding against themselves, so they didn't have any need to necessarily increase it other than to try and make it a sort of smooth, easier transition through. There is quite a large ownership out of South Africa. They may be cautious, but there is a real risk here that BHP could end up being forced or blocked by regulators or walk away from this. And whether you see a kind of counter bid coming from the likes of a sort of Glencore or Vedanta or Rio is, there's a real kind of question mark around that because they haven't thrown the hat in the ring yet. So, not one I would necessarily want to direct anyone to do anything because I could very easily be wrong by the time I've got off this meeting. So, there are certainly risks to it. And I wouldn't say it's going to be plain sailing.
Fair enough. It's one of those things. I'm required to ask the question, and then you're required to say, maybe I better not answer that one. Now, this is one more answerable for you. Precious metals are you described in your very interesting talk at the lowest multiples, yet gold, copper, various other commodities, not lithium, but various other commodities that are quite high. Why that contradiction? Why that contrast? And what does the outlook look like to you? Will those two two sets of valuations meet in the middle?
Yeah, look, I mean, we clearly take the view that we think the gold stocks are cheap and there is a real catch-up in valuation here. Whether those gaps close, I mean, clearly copper has been a real retail favourite. As they kind of term in the industry, it feels like there's quite lots of tourists in that trade, and that in itself kind of presents some risks on the copper mining side. There's clearly been a lot of flows from big kind of macro generalist funds, so hedge fund positioning, both in physical. We've seen some interesting moves just today in what looks like speculative flows, kind of driving fairly volatile moves in the intraday copper price. So we just suggest there's a bit of it, because if it doesn't feed through, the stocks are already implying a higher copper price than we currently see. So we kind of feel much more comfortable kind of putting money into names that are trading at all-time discounts, and we see potential catch-up trades to that as earnings should start to feed through.
So what are you actually putting your money into? What are the lower valuations that you're actually backing with in the fund?
Well, on specific names or
specific names? Yes, please. It just makes it alive. It makes it real for the audience.
Sorry. Yeah, so I probably should have clarified on it, but we're very global in our focus. We don't actually have a lot of UK listed names. So the majority of our names are kind of Canada, US, or Australian listed, just down to the nature of where mining and energy companies are listed. The assets themselves are global, so we have plenty of exposure to across LATAM, North America, Africa, and Australia. Limited amount across Asia, but we do have some specific names. So you look to where we're seeing attractive opportunities. So stuff like Emerald Resources would be one of our largest gold weighting. We think that's very it's a very attractive risk profile. So similar to what Taseko were arguing earlier, we like names that are producers but also have development assets, because we think those development assets are often underappreciated. We also like the fact they're companies that are in control of their own destiny, ultimately, because they have cash flow and production. So we generally prefer producers. We will go into some pre-production, but a heavy discount, and it's not a major component of the portfolio. So Emerald offers that in that it has a very high margin, strong return producing mine in Cambodia, and they have a development asset in Australia, which is kind of district scale, and is that doubly leads to a re-rate, or should lead to a re-rate, as and when they bring that into production. Equally, you can get a multiple appreciation above that, because it's a perceived de-risking of the jurisdictional risk. Actually, Cambodia have been very obliging, the government there. So, they've been giving them more licenses. They've been very fair with tax. The labour issues that many miners have seen globally that squeeze their margins isn't such an issue, because there's a big, large, readily available workforce in Cambodia. Tax regimes remain stable, and they're very, and it's meaningful to the country. So they're highly motivated to keep these projects operating. And very supportive for further growth going forward. So, it's kind of gives a bit of colour of how we perceive regional risk and how we view that.
Okay, final question. Rob and Keith, let me just jump in. We're kind of out of time, but I'll give you another couple of minutes to do this. What kind of exposure can you give investors in your portfolio that they simply wouldn't be able to get for themselves? Like, I can see that you're global, and you describe it as mid-cap, but it's over $1 billion market cap. So between you, if you could summarise why CQS Natural Resources Growth and Income?
I think if I just kick off, I would say that the closed-end structure really just allows you to get that the valuation benefit over everything else, because the less liquid investments that structure lends itself to. In terms of UK investors in particular, well, anything that doesn't have a UK list is much more easily accessed via this fund, whether that's just a Canada list, an ASX list, or, you know, a Johannesburg list if it were down there. But, you know, that I wouldn't labour too much. And, you know, but the real benefit is that we just meet so many managements that give you, you know, we've seen lots of assets come through with different management teams and we know to screen them out. But that's the main benefit. It's the size of the company and it's the jurisdiction in which it's listed.
Yeah, and I'll add to that. I mean, there are some other benefits as well. So, you know, we do a lot of primary deals, which we get shown that, you know, the average UK investor wouldn't get shown. So that allows you to buy shares. In Canada, quite often with that, you can get kind of free warrants, they call it, particularly in some of the smaller cap names. So, you know, into a stronger cycle, which, you know, clearly is something we're kind of anticipating here today, that can really juice up additional upside returns, but, you know, also potentially offer a bit more protection. So, I think really it's that kind of expertise, understanding of the underlying sectors and knowing management teams that is probably the real differentiator today.
Okay, terrific. Rob and Keith, that's Keith Watson and Robert Crayfourd, co-fund managers at CQS Natural Resources, Growth and Income. Fantastic. Thank you so much for speaking to us today. It's been absolutely terrific. Thank you.